Good day. I'm Martin Gagel with Market Radius Research. It's Tuesday, April the 26th. We've got Executive Chair Rob Chase of MediaValet joining us. MediaValet provides cloud-native, software-as-a-service, enterprise-class digital asset management solutions built on the Microsoft Azure cloud platform. Happy to have Rob back with us. It's just been about 2 weeks and a year since he joined us on our first webinar with him. And it's good to have him back. We're here to get an overview and an update on how things are progressing. So far, 2022 has been a very solid year for the company with record new bookings. But please remember, this is neither a recommendation nor investment advice. We're here to learn about the company. Rob, thank you very much for joining us again. And let's have an overview of the company and how things have progressed over the last year.
Great intro. Thank you, Martin. Appreciate it. And good morning and afternoon, everybody. Good to have the opportunity to present to you again. And just before I get into it, of course, the safe harbor statement, as you know, applies as per usual on forward-looking type commentary, etc. Boy, a lot has changed in a year, I must say. It is interesting when you think the last time was a year ago. You know, what's good and what has not changed is our core focus on digital asset management, enterprise use case capability level that is accessible to organizations of all sizes. And we continue to be an outstanding innovator in this space with a lot of nuanced features and capabilities that stand us apart in the industry. And just quickly, a few of those really where we truly stand out on video support, audiovisual indexer. You'll see a lot of our customers take. We are miles ahead in this area from the competition. Great time for that to be happening as the industry analysts will tell organizations, video is your brand's superpower. So you got to get it right. So having a DAM that properly supports that obviously is very important. There's others, just artificial intelligence in general. We stand out on, and of course, what we call our creative spaces, which brings in the creative team into the DAM equation as well. So anyway, high level on us, we've had a solid track record over the last number of years, of course, 43% 5-year CAGR, very proud of that and very excited to have cracked the $10 million hurdle in fiscal 2021 for annual recurring revenue. It's a great marker for a software as a service organization. It's where you reach that scale that you can truly grow from. So a lot of times you'll see organizations take quite a while to get to 10 million, but things start to accelerate after. Part of that is just because they've got the scale to go and execute at a bigger level. We've been busy building out the technology for over 10 years now. It's extremely robust. And as I mentioned, differentiated in the market. In the last year, if you look at the bottom there, we actually went from 59 employees to 102. It's almost like we added a whole new factory, if you will, thinking about it in physical speech. That was a huge endeavor for us. We probably lost 30% of the productivity of our team going out after hiring all these people and onboarding them. We're very picky, and we're really happy, though, to have been able to get these people on board, especially in such a competitive market. And I think it's a testament to our strategy and our vision. And that increase in spend that you'll see as we get into the financials has been calibrated based on the access to capital that we have. Now, very important and near and dear to our hearts is there's 30% ownership on the inside as well. So we want to make sure we don't get ourselves in a position of having to raise capital. Opportunistically, yes, but having to go out there up against the wall, no. So happy to have $9 million of working cap and another $7 million of an LOC that we just signed to make sure that we've got the capital resources in place to fund us through to cash positive with our current level of spend that we've increased to. That's a high level overview of the company. It's been a great year. The other place that things have really changed is the market itself. And Martin touched on it, that we've had a great start to the year with a lot of new announcements for customer wins here in the new year already. And that's on the back of having a solid Q4 as well. So exciting to see the market starting to improve. And a year ago, that wasn't necessarily the case. It's been 2 years of the wet blanket of COVID on things, and we're starting to emerge from that. But what's interesting is we've always thought that COVID is going to ultimately be good for us because it's going to accelerate the digitization of the organization. And organizations truly are understanding they need to be digital first now. So over the last couple of years, a lot of organizations maybe have been undertaking the frontline type of technologies for supporting going digital. But as they get into that, they start to drown in content and realize they need some way to manage it properly. And that's where DAM comes in. And so the announcement you saw this morning, I hope you saw anyway, that's a prime example. I mean, this customer, $133,000 new customer win, they came and started talking to us before COVID. And these trends of digitization, that's because they've been in for a long time, but they had to hit pause during the COVID era, and they've come back and quickly moved ahead after a quick, market check and RFP process. So really, though, it speaks to just how it's accelerating for DAM, and people are realizing today it's becoming more and more mission critical. And when you see that in the industry analyst estimates for the market as well. So at the beginning of this time last year, we were expecting a market that was going to grow to $7.5 billion by 2026 with a 13.5% growth in 2021. That was the analyst outlook this time a year ago. Fast forward to now, the analysts believe that it grew 24%, so exceeded their growth in 2021. We actually grew 32%, so we outpaced the market again, which is great. We expect to keep doing that. But they've upped their overall forecast for the next 5 years by 79% to 13.4 billion. Massive jump. And so, that kind of tells you what the analysts are seeing about the importance of DAM. So really excited to see that. And that's part of why we're leaning in so heavily to the business as well. Increasing our spend, as I mentioned earlier, going to 102 people, basically, adding an entire new facility, essentially.
Rob,
yeah.
Certainly. Can you flip back one slide there?
Certainly.
You got your...
I know, I hate those fly-ins.
Like COVID did a lot of things, and for a lot of companies like Microsoft, who you're platformed on, it's accelerated the digitization of kind of everything. Can you maybe walk us through? It's been a little over 2 years of COVID. Just remind us what happened when COVID first hit. I guess like everyone else, it sort of shut things down, and then and where are we at now in terms of your clients? Okay, back to the slide.
No, it's okay. I'm going to go to a slide. Don't worry.
Okay, sorry. In terms of adoption, how we're all hopefully over the shock of COVID. Can you just talk about how the market has changed due to COVID?
Absolutely. And, flip forward to this slide because it really kind of tells a bit of the story. So when COVID hit, look at our new business in Q1 and Q2 2020. Just got crushed, right? So back to almost 2018 levels.
This slide is new ARR. So that's these are in US dollars, your new contracts that you won. So in Q1 20, it just hit at the end. So Q2 was when it first clobbered you.
Yeah, it really was tough. So a lot of organizations just put projects on hold. And so really down here, 2019, we just had a spectacular year. You can see the net new AR, just, fabulous. Still a record that we haven't achieved again because of a large deal. NBC Universal signed that year, $320,000 in that quarter. So, excluding that, we're at a record here for Q4. But the trend in digital asset management was already there. 2019 was already showing. And so look, the drop was just precipitous when COVID hit. Organizations just put stuff on hold. We went from in Q4 an 86-day average sales cycle to into 120 to 130 range in 2020, and 2021 still was in the 120s. So really organizations were slower to move. And I think, as I mentioned earlier, what I think we were seeing was a lot of the frontline things you think of first getting done, like getting everybody on Zoom, updating your website, things like this. But as you do all those frontline initiatives, you start to realize that you're drowning in content. And so I think DAM comes next, right? And that's what we feel we're seeing now. So as a result, 2021 started to accelerate through the year. In fact, every quarter from a net new ARR perspective in USD, we were either the first or the second best ever for that quarter. So Q1, you can see, was the second best because it was still below Q1 2019. Q2 actually surpassed 2219 to be the first best Q2 ever. Q3, again, second best, but if you exclude the 320 contract, was actually the best for a Q3, and Q4, a record Q4, as you can see here in the green stripe. And it applies down here in customer wins too. You can see what's happening. We added 122 new logos in 2021, well above even our 2093 that we had in 2019. So really, we're starting to see that momentum come in throughout the year here and build. And you're seeing Q1 already with the announcement we've done, it continue to build. And part of the story in the backdrop there too is it is interesting. In 2020, this graph shows another view of this. This is actually our customer wins. It's USD ARR plus upfront fees signed from new customers in the quarter. The blue part of the bar is greater than 50K customers. Okay, so greater than $50,000 of ARR and upfront fees. And the green is below that, which is kind of I call this our singles and doubles versus our triples and home run chart. Okay, what's interesting is we've started focusing on that enterprise use case that we have, where we're really differentiated versus maybe some of the SMB or pure product type of DAM providers. And that's been interesting because there's a lot of small organizations that have an enterprise use case and need an easy to use DAM to solve that problem. And that's where we really shine. So you can see this green section here is really growing nicely for us up to record level in Q4 here as well for that smaller size customer, where that smaller size customer kind of struggled in 2020 for the most part. And we actually ended up having more large deals, which was interesting. And now Q1 2022, we've just obviously through the announcements we've done, we've stated that we've had the biggest, one of the largest in the last year, certainly, and into 2020, the largest customer quarter for new customer wins in that greater than 50 USK bucket, triples and home runs as they call them. So nice to see the weighting or the balance, that sort of smaller average deal size coming faster now again, which is great, giving us a chance to accelerate when we do add these large wins, as opposed to just getting to our numbers, which was the case in 2020, for example. Anyway, so thanks for that question. Does that answer?
Yeah, and I guess a little bit where I'm also trying to get at is like the sales process, or how the customer sort of respond. You've always, I don't think you have a lot of door-to-door salesmen, so to speak. It's all been sort of phone and virtual. And that has their process of evaluating or making purchase decisions altered sort of pre and post COVID, or because they're all on Zooms and Teams and all that?
Well, so first of all, our go-to-market, let's just touch on that quickly, is direct augmented by channel. So we generate most of our business through our direct online marketing, webinars, ebooks, some trade shows, of course. That's how we generate leads. And we have a business development team, 5 BDRs, we call them, that nurture those leads. And when they become real opportunities, they get transferred to our 8-person sales team to go and close. And it's all done remote. It's always been that way for us. It's all inside sales. And we've managed to do every deal this way, even the largest of the deals. So that hasn't changed. What has changed through the period is literally 2020, people didn't know what their process was going to be to get approved. And part of your sales process, right, is figuring out if they have authority to do something, right? They think they do. They're not sure if they're going to get to start the project. So that's what's really changed, to change that sales cycle down. And the way we saw that happening in 2019, we would get 30%-ish every quarter of our deals coming into the sales pipe and closing in the same quarter. In 2021 and 2020, that just didn't happen anymore, right? And in 2022, so far, it seems to be happening again. And we had a $10,000 US a year customer come in that closed in 2 days. That's a record for us. That's not usual, right? Still, we're going to be in the 100-day range or what have you, but that was just over the top. And of course, the one we announced today, although they originally started thinking of DAM 2 years ago, they put it on hold. When they came back, they were just ready to move. They quickly assessed other vendors. They quickly assessed us. They just went for it. It only took 35 days from when it entered the sales cycle to close. So, that's, again, hopefully early indications of what's to come, that the market's improving for them. And the buyers' behaviors getting back to normal. This is just an example of one of the customers signed in our Q4. Again, just give you a flavor. Anyway, so a farm business, right? 90-year-old business. You know, they have a lot of consumer products as well. They signed a 2-year term, which doesn't always happen. We're really focused on 1-year terms, but they pay annually, like everybody does. So upfront, they pay their US $30,000 contract up front. But a couple of interesting things on this customer win. You'll see audiovisual intelligence was one of the modules they took. Again, I spoke to how video is so important. And Office 365 was taken as well, which is an integration to Office. That basically puts a library icon at the top of the menu bar on all of your Office tools. So instantly you're in the DAM, but you still feel like you're in Microsoft. And of course, Wrike as well, which is one of our good partners. And they built an integration to MediaValet. And they either refer as and generate opportunities for us, or quite often just customers come to us because they see that we're partnered with Wrike and they know they need a DAM, so they put us at the top of the list. And we call that an influence deal. We had a lot of business coming this way. So this kind of, you know, a good example of all kind of a lot of the pieces, creative spaces for their operations team to be able to develop materials within the DAM and preserve all the work in process assets as well as the finished assets. So, you know, this is a good example. You know, there's a couple others just. Oh, yeah.
Sorry, could you, very quick reminder, Wrike, you're partnered with them.
Yeah.
Do they do like what kind of a platform do they provide again? I forget.
So Wrike is a marketing workflow organization.
Okay.
And they went out to market to find a DAM vendor to partner with and integrate with, and they chose us. And they built the integration. So on their site, you'll see, you know, information about the value of the two combined. And when organized, they have about 18,000 customers. And when those customers realize they need a DAM, either they'll go through Wrike to us, or they'll just come to us, right? So that's the influence. 26% of our business that we say down at the bottom came from just influence, good through mostly Microsoft and Wrike. And then some of it also got referred, and more than it was in the past. So this is growing for us. I think if we can really nail it on partners, we can get our sales team to the top of their potential. You know, the inside capital partners will say US 500,000 to US 750 a year of new business per salesperson, inside salesperson. So getting to that upper end really requires having a good partnership program, we believe. We added Monday in the fall. They're another marketing workflow organization. We built the integration with them. And there's a few more things to finish up on that. And then we'll be, you know, rolling with them. Hopefully they'll start impacting our Q3. And you know, they're 130,000 customers, so they hopefully it'll be a Wrike on steroids for us. And then Microsoft too, there's been a new development in the fall where we've integrated and been authorized and approved to be on their Microsoft Azure marketplace, which is fantastic. You know, they're leaning into that their marketplace, try and make it a critical part of their story. And as a result, they've reduced the commission rates that they take when they sell product through there. They've started giving credit to their salespeople, which they've never done before. And they are allowing customers to use up their Microsoft Enterprise Agreement credits to buy things off of the marketplace. So, you know, I don't know if you're familiar, but usually organizations will sign an EA with Microsoft that says they'll spend X amount in Azure or what have you. Let's say it's $1 million. You get to the end of the year, they only use 900. The other 100 goes away. Now they can use that credit to buy something on the marketplace. So that's pretty exciting for us. And we just added FFW as well, which is a content management system provider. They do Drupal integrations, a specific type of website management. Anyway, they're the second largest in the world, and the first largest, their main competitor, bought Widen, one of our former competitors, after for the last about 5 or so years doing a white label with a web DAM, which another one of our former competitors, they've gone to Binder. But in any event, you know, that's again, we hope to be a great partnership for us, just because of the nice tie-in between, you know, content management. If you're updating your website, you pretty much start to realize you need something to manage the content in behind. So, you know, it's a good partnership to have.
Rob, sorry, I'm really throwing off your whole flow of your presentation here. I hope that's not messing up too much.
It's not. No, it's
all right.
Perfect. Perfect.
Okay.
Keep them coming. So I'm going to just go, oops, the wrong way. I'm just going to pop back up though, and
All right.
ask you another
Perfect.
question. And go back up to here. So as I was just about to get into this, just a little bit about our platform and what we're trying to do. So when you look at us investing so much in R&D, why, right? You just to understand it's a very complicated area that we're in with digital asset management. It needs to be connected everywhere, and it needs to enable not just the marketing team, but the whole organization to thrive and flourish with their content. So when organizations come to us, they're in what we call chaos. About 80% of our business is greenfield. Today's announcement actually was winning the unseating an incumbent, which is fantastic to see. We think there'll be more of that in the future for DAM, but a lot of the growth for DAM is just that people are adopting it for the first time. And when they're in chaos,
is there an estimate out there on I don't know what size companies actually have some sort of DAM in place, be it a modern one or maybe a kind of slightly archaic one versus the ones that are using Dropbox or Google Drive or something to
I don't have a specific estimate, but what I'm always surprised by the customers I see adopting for the first time.
Okay.
It's fascinating. So just because you're an enterprise doesn't mean you've gone and adopted DAM already. If you have, and you're a legacy kind of enterprise organization, you probably adopted an on-prem. And if you did, you're probably not happy with it anymore, right? So I think Gartner did a study a year ago that said 28% of the enterprise organizations that they interviewed were actually happy with the adoption level of their DAM. 28%. Like there's over 400 enterprises they were interviewing. So that's telling. I think that will come, the disruption piece, but for now we're focused mostly on this greenfield piece. I think that as content keeps becoming so much more critical, I think that's where you're going to see a lot of the legacy enterprise DAM systems start to crack. Anyway, we quickly move people into compartmentalize, which means we're supporting the market team to try and unlock the value of DAM, which is basically, high level. IDC will say 85% savings in your cost of your creative material and a 25% increase in your revenue because you're going to market more consistently, on point, and more timely in a bigger way. So
customers have a hard time seeing this as more than just a new expense item on their business lines, or do they really, is it hard to sort of get them to see, hey, this improves efficiency and you actually directly can drive revenue growth from more consistent and sort of on point marketing?
I mean, it touches both, because when they come to you, oftentimes, like, literally marketing is drowning.
Yeah.
But and so it's not even a like cost savings, it's times more of it's more like, how do I get my time back, right? This is crazy. And and they're frustrated because they can't go to market the way they want to go to. They can't get that branding consistent. They still have people Googling their brand name and using old, materials to market, right? So they just, I think they've come to it as like they're frustrated that they can't get to the market the way they want to.
Right.
Compartmentalized, anyway, siloed in marketing, they start to realize the value. We want to move them as fast as possible into collaborative. So as I showed you in a couple of those customers, they were already taking some different integrations right out of the gate, which gets us ingrained into their organization, more sticky, right? More valuable to them, and a broader exposure to DAM within the organization, and consequently more success for them. So we want to try and get that fully integrated across their marketing stack and across their multiple organizations in the organization, or multiple people, but ultimately get into a foundational layer eventually where we believe DAM is heading, that it's, this content isn't just marketing's problem. You've got learning management systems, for example, where the HR department's creating all sorts of learning materials independent of marketing. How do you keep that brand messaging on point and consistent, right? So if they have a DAM where everybody's working from the same content, you can control that and actually improve how how much you get people indoctrinated, if you will, into your brand. and right from the learning. And then ultimately, we think it's going to go to what we call converged, and our genius brands like NBC Universal get really excited when we talk about this. But this is where DAM is omnipresent and fully aware. So you're typing an email, and while you're typing contextually, it's interpreting and it's serving up assets for you to potentially use to get your point across, right? So hey, Martin, here's Q1. Boom, there's Q1. There's our investor deck. There's our MD&A, etc. I just drag it in to the on the fly, right? So in any event, that's what we're investing on building. We're building features within each of these steps, if you will, and trying to build and do the major building blocks for the future as well. Some of which you'll see this year, like probably you'll see our visual search come out before not too long, which will be a first in the market to have a true visual search capability, inclusive of full deduping visually using AI, which will be just massive, I think, for content. So
what exactly is visual search?
Just like it sounds. So it's you have a picture of something.
Oh, okay. You drop a picture of
it.
that, and then you look for it. Okay.
You look for it, and so if you had, for example, done some marketing, and you're like, oh yeah, I need to use this one again. Where did that one come from? Just take a snip of that piece that was in that marketing, drop it in, and boom, now you find all the assets that have that thing in it, right?
Okay, that's cool.
Yeah, no, it'll be very innovative for DAM and help us again, another piece that'll stand us apart. So
sorry, and you talked about so much work in the R&D side. You've almost doubled your employee base. With I don't know, either on the employees that you added or in total, what percentage are in sort of product development versus like customer sales support and that? What have you been growing faster? Or is it kind of equal?
Yeah, and I think you can probably even just really see it even here, right? In the financials themselves. And so you can see, R&D obviously is up the most, right? So we definitely leaned in heavier there, because we want to get as much of this differentiated platform and vision built out as fast as possible. I mean, that's a discretional thing for us, right? It's how fast do you want to move, but the team's really excited about it, particularly as the market's growing like it is. The more you add those features, the more your sales team's going to be able to get to their potential, and the more your existing customers are going to be able to expand. So, really, for us right now, it starts with R&D. Over time, we will get it down to market normal percentages as a percentage of revenue, but we're leaning way ahead right now. And consciously learning it way out. I mean, we burned through $7 million last year in actual capital. Just while we're on this slide, right, a couple things about the Q4 and fiscal 21 financials. Number one is when you're looking at our revenue growth, recognize that we bill 100% in US dollars. So the decline in the US dollar last year obviously impacted our growth rate, and you can see it down here in annual recurring revenue. We grew 25% Canadian dollars to 10.8. But in the U, I got the US dollar amounts here for you as well. We actually grew 32% in USD. Revenue would have been 31 when we calculated on constant currency, and of course, our billings as well were up 24, but would have been in the 30s if it weren't again for the FX headwind. But billings is our invoice sales in the period. Okay, so that's how much we invoice to our customers. We watch that very closely because obviously we're trying to figure out how much can we spend today and live within our $9.2 million of working cap and $7 million LOC. How much can we spend and make it to cash positive on that? Okay, that's our equation. So billings is what's going to tell you that, because that's the cash in the door. And on a billings basis, we actually burned $1.2 million in Q4, 7.1 for the year, as opposed to the 2.6 EBITDA loss and 8.3 for the year, because revenues lagged, right? It's the lagging indicator through deferred revenue. And you can see our deferred revenue has actually started to increase in its rate of increase at 28% at the end of the year on year increase. So that sort of gives you a look forward as well. But the other piece on this slide to note, Q4, $5.2 million run rate spend. So we added all those people throughout the year. Most of them came Q3, Q4. And so, we'll have the annualization of that for 2022. plus of course your variable cost increases and some inflationary increases because payroll obviously keeps on going up every year, particularly in the tech sector. So, you know, that gives you this kind of, I think analyst consensus is around 24 million for 2022 for spend. But that's keeping our factory at the same size, if you will, 102 people, plus just the incrementals on the edge that you have to do with volume. So, so you know, we've gotten to the stage as far as we can today on the capital resources we have, and we're looking forward to, as I said earlier, you know, we consider our current run rate of 32% growth in ARR, which is in US dollars, which is what we grew in both 2020 and 2021 as our baseline. Analyst consensus is actually for about 35% growth. And, you know, as we mentioned in our Q4 call, we're fully expecting the spend that we've done to give us the opportunity to return to a 40% CAGR for the next 5 years when we look forward into the market. So that's really what that's all about. And I'm going to make sure we covered everything, Martin, quickly.
Yeah.
Here's a couple other customer examples.
You again, I have to.
No, it's good. I really appreciate that. I think we've covered everything here that we needed to cover. The last thing, obviously, is our net retention, which has been a good story for us. You talked about COVID earlier. When COVID hit, that hurt a bit. Customers struggled to expand, and our gross churn also increased a bit because we just had some customers that couldn't continue. Some went out of business, some just had to cut back to a skeleton crew, so they're cutting everything. Sunwing was a customer, for example. That was a big loss for us. So in any event, Q1 2022 and Q4 both now have had net retention of 100%, back to 2019 levels 100%. So really, I feel like we're through that COVID era. It's been extremely sticky. Our gross churn rates continue to be half of industry average. So we're pretty excited about that. I think that tells a bit of the story, but we can do better through the investment we're doing in R&D. I think long term, we're probably more in that 105 to 110 type net retention. So that's the long term goal that we're focused on at this point. And then you know, this was again just a couple of examples of customers signed in our fourth quarter. A not-for-profit organization. They have the opportunity to grow significantly more. 70-plus-year-old organization. Tons of content that would be extremely valuable if it were all brought into the cloud. This is just a starter point for them. Again, audiovisual, a big piece of that. And then a very large film festival. Exciting to have them come on board as well. Again, audio visual is a piece of this. They actually signed a 3-year contract paying annually, and have Contentful's one of the integrations we've done. Adobe is another one. So we're getting sort of into the collaborative piece there with this organization out of the gates as well.
When people sign up for multiple year programs, they still pay year to year. I'm assuming the incentive to sign up for a longer term contract is they get a discount the longer they sign up for. Or
no, not really. You know, we've been really happy with our gross churn rates. So we don't want to delay our sales cycle by trying to get people to jump through some additional hoops.
Yeah.
Right. So whether that's paying up front for multiple years or signing a multi-year contract, we'll let the customer drive. And, you know, it's interesting. Part of why we're seeing a little different in the industry is, you know, our kind of internal mantra is we care. And, you know, we collaborate really well with the customers. That's why we have a lot of innovations that others don't have. But that caring attitude kind of goes all the way through, right from to the beginning. And, you know, if a customer wants a multi-year contract or they want to pay multi-year up front, okay, let's do it. You know, we don't have a problem with that. Yeah. But our salespeople are incented on 1-year deals.
Okay.
So we don't want people artificially pushing someone to up their numbers. And when you do that, you lose, as you noted, if you sign a multi-year and you're pushing for it, you're going to give a nice discount to get that multi-year, right? So if your churn rates are low, like ours are, then I think you're hurting yourself to do that. So the team's very focused on just caringly winning with the customer.
And
And
switching
again,
costs are fair. It's not like switching out of an ERP or something, but switching costs are fairly high on a like organizational basis. So once people are in, unless something's really going haywire, they're probably not going to switch out, as your numbers show, after the first year.
yeah, I mean, so what that depends upon is the adoption,
Yeah.
right? So
Okay.
if you're into collaborative, that's going to be really hard, because whoever you're going to, if you're switching out, has to have all the same integrations or a detailed enough API to be able to let you customize it, or you lose those things you've come to rely upon. So I think really for us, if you're, we would call them kind of customers that are on the outskirts of our ideal customer profile, would be ones that don't truly have an enterprise use case. So really, they're using it more like a photo library, in which case they aren't leveraging a lot of the higher end capabilities. And so those ones could be less sticky. And consequently, that's where we tend to lose our customers. Our average value of a churned customer is usually somewhere between 50 and 60% of our average ARR in our population. So it's the smaller customers that we're losing, and it's because some of those may not truly adopt it in an enterprise fashion, which makes it easier to switch out, but it's still not easy. I mean, we had one customer, New England Patriots, that switched out 3 years ago, and they had like 1 million photos in our library. So even though they only were using it in this sort of photo library sense, so it wasn't truly collaborative, it wasn't really adopted in the way we would like, so they were able to switch to a photo library type of organization, which is a hell of a lot cheaper. But it took them a year to get off our platform, to get all those assets over, and to get some semblance of the meta tagging and metadata across, which the other one couldn't accept most of it, right? So anyway, so yeah, so even if you're just a low level use case, it still can take a long time. Anyway, you mentioned it earlier. I just had a few slide here to update, because these were Q4 results, and so we're excited about obviously Q1 here. Unprecedented for us to have this many large customer wins. As we noted today, our net new ARR will exceed our Q4 for the first time ever. So usually as an organization, everybody's focused on their year, and in Q3, Q4, we're our biggest quarters. We're just pulling everything through the pipe and draining the pipe, right? By Q1, you're essentially, I mean, obviously you open with pipe, but I mean, you're rebuilding, right? So usually Q1 seasonally has been our slow quarter, as you saw earlier in this slide that we have up here, that kind of got into some of those customer metrics, right? So Q1's always been low, right, on net new ARR. So for the first time ever, Q1's going to exceed Q4. I mean, just dwarfing every other Q1 that we've ever had. So it'll, that means it's doubling our prior best quarter ever for a Q1. So pretty exciting to see that starting to happen. It doesn't mean that it's going to stay that way all year. We didn't expect to get to that level for net new ARR until Q3, Q4, if you will. But what we are seeing is some of that pent up demand releasing, I think, as we mentioned from today's win. And so, yeah, we're pretty excited with what we're seeing so far. And again, that's just, validation for that investment we've done, and getting us out ahead of plan is an exciting place to be.
And are you seeing on the ones that were done in Q1, and like the one you announced today, we're out of Q1, but was it just sort of a prior contract that was announced, and or is that more of a Q2 kind of?
Yeah, so it just, obviously as a SaaS organization, the critical thing is the customer's gone through the sales process, they've got their access, they've started to configure all that. By the quarter end, they've decided to go ahead, but we allow them time to sign the contract, because we have we don't have internal counsel, so it can take a long time, especially with a deal of that size, to get that contract threaded through the needle. So so we don't announce until the contract's actually signed, and so that's why you see these coming after.
You mentioned one that was super quick turnaround on it. Are these contracts in Q1, did they just happen a lot faster, or was it sort of the average duration from sort of start to close? And I guess what I'm trying to get, did this pull forward some sort of potential bookings from Q2 and Q3, let's say, or is it just sort of the flow?
Yeah, good question.
A higher win rate,
Yeah.
let's say, versus pulling forward.
Yeah, I think the way I would characterize it is this. So first of all, our pipeline, every month we bring in hundreds of leads.
Yeah.
Like that's how active DAM is. Okay. And every month our BDR team is converting leads to sales pipe at the rate of, you know, anywhere from 60 to 70 a month. Okay. So even though we're closing deals, and maybe some of them we originally thought would have been Q2, we were able to pull some in because they were ready to move. We thought originally they'd be Q2, but they were able to come to Q1. Definitely there was some, but there was also some like today's that were, you know, on hold, all of a sudden, boom, let's go. Right. So, and as a result, we actually, I think we'll end up with less than 100-day sales cycle this quarter. So excited to see that. But, you know, so that's across the board happening. We obviously enter Q2 with pipe still, right? And so, and again, we'll be building through the quarter. What's interesting is in 2020 and 2021, unlike 2019, deals would look like they'd be for the current quarter, but they'd end up pushing. And in 2019 and in so far in 2021, deals would look like they would be next quarter, but they come in this quarter. You know what I mean? So we'll see if that continues, but that's been kind of what we've seen start to happen again. So and so it's an unprecedented situation for Q1 as a result. Because usually we probably would have drained a lot of the swamp, as we call it, in Q4, maybe been able to get some of these larger deals in Q4 more in 2019, maybe, I don't know, but you know, that's usually why a Q1 is quieter.
Are you seeing any change in the types of businesses, or you're in your funnel that they're larger businesses or more smaller businesses, or like the average deal size or the industry that they're operating within?
So industry just continues to be across the board. And so our marketing is geared towards marketing teams with high value content. Okay. So, you know, they exist everywhere, from not-for-profits to manufacturers to consumer product goods, as we announced today. And by the way, consumer product goods, we were terrible at in 2019 and 2020, but our R&D team is, you know, added, you know, some you know, branded portals, we call it, some distribution type capabilities and things that have put us back in the sweet spot for consumer product packaged goods. So we're starting to see a lot more of those come, and we're winning those now, which is exciting. But what our focus is in that marketing is to go after the enterprise use case for customers of all sizes. And so back to that earlier chart where I was showing you that we're seeing a much bigger piece of the pie coming from just singles and doubles. Well, that is what we want to keep happening. Yes, we always see these large deals coming, and they're more binary by definition, right? When you get into these large ones, it's a winner or not, and it's a big piece, right? So we're trying to get to as much of our goal as possible off singles and doubles, so that those larger opportunities can truly be wins. And we just so happen to have had a lot of them a bunch close this quarter. There's always more, and they're always coming, but you know, it's unusual to have this many come in a quarter.
Will that continue?
I hope so. We can't predict the future, but we're building it to do so. So we'll keep at it.
All right. Are we done here, or so we bounced around a whole lot?
Just, you know, last slide, just, you know, where we are market cap wise. I think we're at about $1.90 now. You know, 52,500 shares trading a day, so decent volume. I've got some valuation information just to make it easy for you to calculate. This is the analyst consensus for fiscal 2023. Basically 35% growth per year, as we sort of ties in with what we talked about earlier. The reason 2023 is up there is because just, you know, the analyst report that we have latest from March has a peer group that is using 2023. So you can compare to what they had there. You know, we feel like, you know, hopefully as we continue to execute, not only will we get the, you know, increases from actually the growth itself, but also hopefully earn ourselves back some multiple expansion. And, you know, we've got some money coming in right now from warrants as well. I exercised 361,000 in March as well. So bought those out. And so we'll have about $2 million come in over the next 6 months or so through warrants onto the balance sheet. And obviously that'll increase our insider ownership a little. And good institutional coverage as well. So, you know, really just looking to get the word out there, make sure people are aware of us, putting us on their radar. So hopefully we can keep, you know, bringing them some good announcements like this along the way. And I think that's what's to watch for, right? You know, some product stuff, maybe visual search type related, maybe coming out. But, you know, just really, let's see. I think our numbers without the FX headwind for us this year, I think our numbers will look better than they did last year, and hopefully that'll start to help people see what we're seeing and why we're excited about the business.
All right, we have a question here from the audience, and I was going to dig into that as well. Could you talk about the competitive landscape and how that's changing, and like you mentioned that you're in the consumer product space, you're making gains there. It's a race, so everybody's moving and gaining or relatively losing in certain sectors. Your perspective on the competitive situation?
Yeah, I mean, the starting point for competitiveness is target the right customer. If you have the right customer group where your advantages shine, you have a better chance of winning those deals. And so that's, you know, we're looking again for enterprise use cases. We're looking for, you know, we also be looking for legacy systems that are out there that the customers might be getting long in the tooth with, and you know, opportunities to disrupt. But, you know, really we see video as a massive piece of the future. So we're just leaning in heavily there. And as I said, we're already differentiated. I think, you know, and we will continue to innovate and collaborate with customers to make sure that the innovations of today, hey, they may not, are the differentiators of today, that we might not be standouts tomorrow for those, but something else will be. And so this example I gave you would be visual search. And so, you know, we're going to keep doing this through our vision on that DAM maturity model. But what's interesting, I think, when you look at the market, and this continues to be the case, a lot of the customers or competitors are down to the left of us here. As I mentioned earlier, Binder bought WebDAM. WebDAM was the white label for Acquia, the biggest content management system for Drupal provider, who then, you know, because Binder had WebDAM and it was sunsetting it, they went and bought Widen. So you know, there's some acquisition coming. I expect you'll probably see some of that in the competitive landscape, some cleanup, because there's a lot of smaller competitors that maybe are struggling, that could be great opportunities to buy customers and people for a larger organizations, and we'll indeed watch for that down in the future. But these ones down to the left, predominantly they're a bit more product focused, like check the box, provide just SMB level grade capabilities. Whereas we're focused on building deeper features and solutions that are more flexible to be able to be enterprise class. And so they've got a lot more features than us as a result. But that's part of why we're leaning into R&D, not only to build out those features in a better way, as in greater solution focused as opposed to just product focused, and at the same time work on these differentiators that I was speaking of. And again, we still see, when we see Adobe in the market, we just don't see them that often. I think leaning into our partners is trying to help us get in front of Adobe opportunities more, but we win 3 out of 4 when we come up against them, because our system is, you know, cutting edge. So, and the differentiators that we talked about.
You mentioned
So
that some of your competitors, to the lower left, have more features than yours, but you are more integrated into the client's system. Did I get that right? And
our solutions are deeper, meaning that they're let's say artificial intelligence. Okay, you
yeah,
can roll out artificial intelligence just using some AI engine and plain vanilla type meta tagging, or you can go and you can bring in that engine, and then you can actually start adding specific value add features and capabilities relative to the customer to truly make it relevant to them. So as an example, um, if the AI can discover a building, but I don't sell buildings, then who cares? Okay, so plain vanilla would just do that level of AI. We do a true solution level of AI. So that's what I mean by deeper features, as an example. And so we try and build them deep. Plus, all of our stuff is triple redundant globally. It's hyper scalable. So it's got to be built to be stronger because it's going to be stress tested more. Okay.
What about those? So yours, when you do something, you view it as it's a better solution. They have a sort of a checkbox. Yeah, we have AI, and they check it off, and it's not as robust as when you roll it out. That's the sort of the short form of that.
That's what we hear back, is we hear plain vanilla versus true solution.
Gotcha. On this chart here, you've got a couple competitors that are sort of the up and to the right of you. How do they fit into the universe?
Yeah, they're more custom based, so they more have a headless platform basically, and their job is to come build it into your organization. So a Primo, for example, I think they have only like 200 customers, but their revenue is like in the 50 to 100 million mark, because they're doing massive custom implementations. And so we don't even see them, and we don't see those opportunities because they wouldn't be looking at a packaged, if you will, solution. Theoretically, ours could get there because we have a application programming interface that actually pulls every single feature within our system. So a customer could completely make us a headless dam, but that's not how we sell today. So we don't get in front of those opportunities.
Gotcha.
A lot more professional services associated with doing that, right?
All right. Okay. Another question here. Would it be advantageous for you to move to the US? If not, when do you convert your financials to US dollars, and the potential of listing on an American exchange?
Great question. So first of all, we will end up with an office in the US at some point. That's going to be part of our natural evolution.
And just to, like, offices are kind of, it's a new concept now, given that I don't know how many of your employees actually bike into the work every day, and how many are working from their basement, living room, condos, or whatever. How are you managing that hybrid work model?
We still haven't opened our office since March 2020. We're actually about to open it again. We've converted it to more of a hotel and coffee shop kind of feel. And so, people will be able to book out a desk and a space and things for the day. But no, we're a work from anywhere organization now. And when they do come in, hopefully they bike or commute so that our carbon footprint remains low like it is now. But so it is a strange concept, isn't it? An office. But we will have a water cooler. And at some point in time, more presence in the US, maybe that's something we get through an acquisition or something, who knows. But certainly we will continue to look at that. In terms of reporting in US dollars, we have looked at it, and unfortunately we don't have enough, because all of our cost pretty much is Canadian, and our funding is Canadian. So yeah, we can't really adopt a US dollar as our functional currency today. But at some point in the future, I suspect that probably is something, well, that's something we'll definitely continue to watch. And listing on the US definitely is something we're interested in doing as well. We think there's obviously 70% of our business is coming from the US. It would resonate down there, we believe, from an investor perspective too. So, a QX listing or something we think would would be a great start, for example. And we've just added our CFO in the last few months. He's been fantastic. But now with the people we've added, we've got the bench strength. Sorry about that. We've got the bench strength to get to to get to some of these to consider some of these opportunities, right? So.
All right. You just mentioned in case you do an acquisition, that hasn't been part of your life to date. That sounds like it's a possibility. Obviously you can't name names, but like sort of adding in features or buying a competitor that adds a big new customer base, what kind of rationale would or sort of expand your product into new markets, like new functionality? Could you potential concepts behind an acquisition?
Yeah, look, I mean, there's lots of adjacencies for us, obviously, in the space that we're in. So, and there's lots of nuanced features that we're adding within DAM, whether it be video or what have you. So, definitely there's opportunity to look at adjacent type technologies, or middleware, if you will, type technologies. And we haven't had the bench strength yet to do it, because we've had so much organic growth opportunity that's been the core focus for the entire team. But as we get larger here in that bench strength, we can actually start to look at potential acquisitions. I think that the lowest hanging fruit for us really is more, you look at some of these competitors, and this is only a handful. I mean, there's a bunch out there that aren't even listed here. There's some good consolidation opportunity in the market. We think there might even be some in the area of on-prem type systems that are just stagnated, because no one wants, people don't want on-prem like they did, and they can't keep up with the speed, the pace of SaaS. So we're hoping we'll find an opportunity from a competitor like that would have a good customer base, have maybe bring a different geo for us, maybe bring employees for us as well, acquihire. So, and some nuanced technology that could, be built into MediaValet and help us differentiate again. So, so we're looking around to see if we can find some of those, and if we can at the right value, then that's something that we would love to entertain to augment our I mean, really, as you know, in tech, scale is so important. So to be able to, get customers and people quickly in that manner that are already expert in DAM would be definitely valuable to us to accelerate our organic growth.
You said 70% prior in terms of customers. You are currently, your business is North American focused, 70% out of the US, a little bit out of Canada and globally, or how do you like your global footprint, and what would it take to become more international, I guess?
Yeah, so I mean, already, we are getting business coming in from EMEA and Asia Pacific, and with our Microsoft footprint through the Microsoft Azure backend that we have, we can light up data centers all over the world, and so we can give data residency guarantees in places that others can't. And that's in part because we're platform as a service, which is a little different from infrastructure as a service. So lighting up a new jurisdiction with infrastructure as a service is a little harder. But ultimately, we're doing that with no presence there. So what could we do with presence in some of these different geos is the question, right? And doing it yourself, having done it before, international expansion is it's not the simplest thing in the world. And if you have a good footprint there from another organization, might be a better way to go rather than trying to do it from scratch. But I think there continues to be lots of opportunity internationally in EMEA, et cetera. They're behind the US, right? Everybody's behind the US from that perspective, but they're catching up.
And because you're all inside sales, remote, Zoom, phone calls, emails, and so forth, is it just a language barrier, or maybe some sort of business culture barrier that's sort of impeding their markets?
Well, I mean, international has a bit of everything, right? I mean, what you get as a North American organization marketing to the world is you get what you call the low-hanging fruit, right? You get the organizations that don't mind English first and English only support and all that kind of stuff, right?
Yeah.
And they don't mind the time lag, etc. I mean, there's you get those adopters, but if we're truly going to be there, you're going to need some language capability. The system, and it's part of what the R&D team is working on, needs to be localized, and we need to have multilingual support, both from a technology perspective and from a people perspective. So yeah, I mean, those are parts of being successful. Feeling local despite being international usually requires some local element involved. So
Yeah.
so we are, I just don't think, you don't want to trivialize, how challenging it can be to truly push into a different market.
Okay, makes sense. And we have a final question here. With the highly customized solutions you provide customers, how much additional engineering resources do you need to commit to close the sale? Is professional services a line item for revenue? If so, what is the growth target for that? Sort of two questions in one there.
Yeah, no, great question. So let's go to the first one in terms of commitment. And it's hard for smaller organizations to say no, but the team's been pretty good at it. And the reason that you say no is if someone wants something that's not on your roadmap. So if we're going back up to our DAM maturity model, look, we want to have features that are going to help us to win today, and we want to build this differentiated vision for the future. So the first there, right? That's what we're trying to do. And so if we get a feature request from a large customer that isn't on that map, it's really hard for us to even consider doing it. We don't usually do custom work at all. We will build and commit to things if it's already on our roadmap. So we will happily adjust the roadmap timing and be nimble that way. Large customer comes in and they think that feature XYZ, they want it in the next 6 months. We weren't planning to do it to next year. We're bumping it up, right? As opposed to specifically building something that's only going to matter to them, we say no, and we suffer those consequences because it would mess up the future. So that's the first thing. But also that creates an opportunity. So we have partnered with some system implementers and things who now have the ability to build out those using our API to actually do some of those. So if we I'll zip down here to our integrations. It's kind of in our appendix section. Wasn't really going to get onto those today, but let's get into them a little bit. So these are our kind of out of the box ones, right? But this open API is extremely robust that organizations can use to build it into whatever they want. So this one here, Sprinkler, we've never even seen it. So one of our largest customers wanted an integration to Sprinkler. Sprinkler said they would build it themselves. They didn't want to work with anybody else. So they grabbed the API and our customer hired them to go and build an integration using our API. So it can be done, as deep as you want, and we can get other organizations to do that on a pay for basis. But our focus is get the ARR, right? Product ARR, annual recurring revenue. Every single deal has an upfront fee, okay, to get you up and running. And so that's
the initial implementation to make sure it's all connected properly. And absolutely. Some companies are less work, so less fees, and more integrated, you got to charge up front for that.
On average, it's 18%. So if we announce a $100,000 deal, likely 82,000 is ARR, 18,000 is upfront services. And gotcha. That's simply set up the taxonomy, their decision tree, set up their approval process, train the people, and help them with their first upload, if you will. We have a desktop uploader that they put locally on their desktop, and they just start shoveling data into it, content into it, and it runs it up at high speed up into the cloud. So but we got to get them started first with the right starting point for their basic meta tags and their tree structure and all that kind of stuff.
And I'm guessing the gross margins on that upfront implementation isn't in the high 80s, 90s. That's more 50-ish% or something like that. So those more
Yeah.
wins. So it's a good reason, but it drags down your gross margins a bit.
Yeah, and so it's only, as I said, 18%, right?
Yeah.
So it's not massive, even if it were only 50% margin versus 82%, which is our average, right? So
Yeah.
it's encompassed in every single, like in our numbers already. There's been no change in that over time.
All right. Okay, good stuff. And yeah, so we're well into an hour here. I think we've hit the high notes. Are there anything that we haven't hit upon that you want to highlight before we wrap it up?
No, I think it's been a great interactive discussion. So, I just really hope, in the wrap up aspect, that it came across in terms of, what we're seeing in both, as we talked about the market, why it's growing, and the analysts sort of increasing their expectations year on year for the DAM market. What we're seeing in terms of that building capability that we talked about with the customer metrics, right? So getting to record level net new ARR in USD, seeing a bigger component of deals coming from singles and doubles as opposed to relying on triples and home runs. So all of those good metrics, getting our net retention up, etc. We're seeing that momentum, and again, seeing it come into Q1 here with the announcements we've done. So that's hopefully helping people understand why it is we're leaning in so heavily to this opportunity. As I said, it is discretional, right? We peg that spend based on our available capital resources, and hopefully through the discussion, people can see why it is that we did that, and we're over the moon internally to actually be ahead of plan for Q1 as we announced today. So that just really gives a little more breathing room even on that equation in terms of us being able to get to cash positive based on our available capital resources. So yeah, that's key messages, right. I think that I hope that came across.
I think so. All right. Thank you, Rob. Thanks for taking the time to chat with us. Great seeing you again, and hopefully we'll talk again. Maybe not so we don't have to wait a year again to chat.
Thank you. Awesome. Appreciate it, Martin. Thank you very much.
Cheers.
Bye, everybody.